Ladies and gentlemen, dear colleagues, on behalf of the Faculty of Law, Criminal Justice and Public Administration of the University of Lausanne, it's my great pleasure to welcome you all to our annual two days transfer pricing conference organized by our Tax Policy Center. We are grateful to Professor Robert Danon, to Professor Vikram Chand, as well as to Professor Guglielmo Maisto from the Università Cattolica di Piacenza for putting together such a topical conference. We are also extremely thankful to all the speakers whose efforts have made this event possible. I'm indeed delighted to report that more than 600 participants have registered to this conference. This underscores the importance of transfer pricing in the current and future international tax landscape. Moreover, the success mirrors the one of our executive program in transfer pricing, a new edition of which will begin this February. Of course, the focus of this conference is truly international. Therefore, for those of you who are looking for Swiss tax focus, I'm happy to report that our Journée de Fiscalité des Entreprises in French will be organized by the Tax Policy Center jointly with our Center for Enterprise Law, CEDIDAC, on 11th March, also in the form of a webinar. I will not disclose the content of the conference, which will release next week. However, I'm sure that you will enjoy this event as well. So I wish you a very nice conference with you to stay healthy and well, and I'm confident that we will soon be returning to at least a normal life. So with that, I hand over to Professor Danon, the director of our Tax Policy Center, and thank you for your attention.
Thank you very much, Mr. Dean, Laurent. It's a pleasure to open this conference today. Actually, a few things. We did not have a transfer pricing conference in the past, so this is the first transfer pricing conference that we are organizing, and as you say, I'm very happy that we have over 600 participants, which really crystallizes the importance of transfer pricing in the current landscape, but also in the future landscape. So the purpose of this conference is really to take stock of what's happening right now in transfer pricing, in international tax litigation, and then also to disclose and to discuss what will be the future, in particular in the area of taxation of digital economy. And we feel that the timing for this conference is quite nice, because we just ended the consultation at the OECD. Now, a few personal remarks as well. This conference, of course, would not have been possible without the partnership of two other colleagues. So the first, of course, is my colleague Vikram Chand, who has been appointed as professor at the University of Lausanne very recently. And he can testify that I've always been saying, well, we need a transfer pricing, we need a transfer pricing conference. And so I'm very happy that shortly after his appointment, he has undertaken the task to set up this conference. And last but not least, I'm extremely grateful to my colleague and friend, Guglielmo Maisto, for joining us in the preparation of the event. Our friendship and mutual respect and the interesting discussions that we have regularly together have fueled the program of this conference, and I'm very happy that we're able to do this together. So as I say, this is the first transfer pricing conference. As our dean has reported, for those of you who are interested in Swiss tax law, in Swiss corporate tax law, there will be another conference this time in French on the 11th of March, Journée de Fiscalité des Entreprises, in which we will be dealing with the Swiss landscape in greater details than today. Also to report on the activities of the Tax Policy Center. Of course, the focus of the Tax Policy Center currently is on tax treaties and transfer pricing policy. We recently added a new pillar to the research, and this is typically the interaction between tax and investment law. This is a project that is being set up in the field of international arbitration with our Center of International Law. We're also reaching out to other foreign academic partners, but this will be also one of the key focus of the center in the coming month. I think before we open the conference as such with the first intervention by Matt Andrews, I think I'm going to turn over to Vikram and then to Professor Guglielmo Maisto, and we will also report on the new release of our joint publication on profit split. So perhaps Vikram, a few words, and then Guglielmo.
Thank you, Mr. Dannon. I'll just keep my intervention very short and sweet at this point in time. So we are extremely excited here at the university to launch this conference. Indeed, we have around more than 670 participants who have registered for this conference. So we are very happy because this is the first conference we are doing here, and we've seen the kind of participation from the people who are interested in the subject. So we really feel now that the research that we are doing here at the university is quite relevant too, in light of the number of participants who also registered for this conference. Apart from that, we have a fantastic lineup of speakers who are waiting to speak on various different topics, ranging from services, intangibles, profit allocation to PE, commodities, the digital debate, and what the future of the entire profit allocation system of taxing multinational is going to look like. So I'm really excited about this conference, and I'm looking forward for all the panel discussions too.
Thank you very much. And perhaps just an addition before I turn to Guglielmo Maisto. Of course, if you are interested in transfer pricing, what needs to be mentioned is, of course, our executive program in transfer pricing, which will start this February and basically mirrors pretty much the content of this conference. Now I would like to turn to Guglielmo Maisto for a few words on the conference, and also perhaps to say a few words on our joint project, namely our new edited profit split book. I'm delighted that we were able to do this together and to publish this book with some of the speakers who are actually speaking in this conference, some of the authors who are actually speaking in this conference. So maybe, Guglielmo, the floor is yours, and maybe you wish to say a few words on the book and on the conference.
Thank you, Robert, and good morning to everyone. And indeed, I'm also very excited about this conference for the reasons that you have all mentioned. In addition, I would say that the subject is on transfer pricing, but as the program indicates, it covers also some ramifications of the profit allocation. Ramifications which we shall see later may have to do with projects of the European Union. It may have to do also with the influence of new profit allocation methodologies on other taxes, so other than corporate tax. So it should be an interesting and challenging discussion. On the book, indeed, it's a nice opportunity also to mention the project that we have conducted, which resulted into a book on the profit split, which is a book which was just been published and which covers several aspects of profit split, starting from the history of profit split in the OECD recommendations over time, and the evolution of profit split. If one looks from the 79 through the current guidelines of the OECD, and including also references to profit split interaction with other taxes such as VAT, for instance, and at the end taking into account the attitude of United Nations and the Joint Transfer Pricing Forum. So I would, as Robert also said, thank also the other contributors. Most of them are speakers at this conference. And so I was very pleased and honored to be involved in this joint work with Bikram, Robert, and Gabriella as editors of this book. Thank you.
Thank you very much, Guglielmo. Indeed, I think the book comes at the right time and will contribute to the debate. So I think with that, perhaps even with a few minutes ahead of schedule, we're ready to start the conference with Matt Andrew. So Matt will be delivering the opening speech. It's an umbrella speech that is also designed to fuel the discussion later on and to set the scene. The topic of his speech will be profit allocation within MNEs in the new decade, coexistence of the separate entity approach and the MNE Group approach, potential areas of tension. Matt, of course, doesn't need an introduction, but he's the head of Tax Treaty, Transfer Pricing, and Financial Transactions Division at the OECD in Paris. Matt, we're very fortunate to have you as the opening speaker in this conference, so the floor is yours. Thank you very much.
Thank you very much, Professor Danon, and I'd like to thank the university for the opportunity to contribute to this discussion today. And my special thanks to you, Professor Danon, and Professor Chand as well. Let me just share my screen at this point in time. I have a few slides. I won't speak for very long, about half an hour, but I will share my screen. Let me just do that now. Okay. Okay, Professor Danon, can you see my my slides now?
Yes, very well.
Thank you very much. Okay, so the topic I'll be discussing today is the coexistence, as mentioned by Professor Danon, of the separate entity versus the group approach. And in particular, what I will cover off today is in particular the group approach to calculating amount A. And so this will be a half-hour brief presentation, and I'll touch on the current separate entity approach to allocating profits to separate entities as governed by Articles 7 and 9 of the Model Tax Convention, which may need to coexist in the next decade with a group-wide approach to calculating the amount A tax base and allocating amount A to tax jurisdictions. So I'm going to touch on a few subjects here, and a few questions actually. So why not shift to a group approach to allocating profits? Is amount A an acceptable halfway house? Highlight some potential areas of tension between the current separate entity versus the group approach, and ask ourselves the questions as to how these tensions could be addressed. And finally, provide some final comments for the following panel discussion. And so that's what I'll cover off today. My next slide, as you can see from the diagram here, the allocation of profits to entities and PEs, or permanent establishments, are governed, as I mentioned, by Articles 9 and 7 on the left-hand side, and that's of the OECD Model Tax Convention. So both Articles 9 and 7 are premised on this separate entity approach, which requires that profits are attributed to an entity or a PE, which would be derived as if they were independent enterprises engaged in similar activities under similar conditions. On the right-hand side of the diagram, you can see that Pillar 1 departs from the separate entity approach for designing amount A, and relies on a group approach, which is premised on a consolidated profits of a multinational group. And that's as determined by the applicable accounting standards. And as we've mentioned, I think in the blueprint, that would be IFRS or IFRS convergent accounting. And so before we progress any further, I mean, I'm going to give you my view. So this is not the OECD perspective. This is my perspective of the issue. So I think it's important to note that it is easy to see that the separate legal entity approach is in opposition to the group approach, but I don't necessarily see it this way. And clearly the separate legal entity approach retains its primacy as the basis on how international corporate taxing, corporate income tax system works, whereas the group approach, as it relates to Amount A or Pillar 1, operates a system overlaying the separate legal entity approach, and it specifically relates to the taxation of in-scope Amount A entities, i.e. quite a small portion of companies. So in this regard, the group approach operates, in my view, as it relates to a discrete aspect of the international tax system for a specific reason. And so, i.e. it's not actually in competition with a separate legal entity approach. And while this no doubt creates tensions in the system, it is important to note that tensions already exist within the separate legal entity approach, specifically as it relates to the complexity and consistency in approach to profit attributions to PEs. So accordingly, I think it's important to note that the international tax system already practically deals with tensions, and we should approach it hopefully in terms of absorbing the group approach for Amount A purposes. And I'll come back to that particular point. I think it's important. So to me, the question is, why not shift to a group-based approach? And to me, it's clear that the separate entity approach is not in any immediate danger of being supplanted by the group approach. And why? Well, some reasons I think that are important. Countries continue to want sovereignty to determine the tax-based rules, and group-based taxation without common rules would be very complex. Group-based taxation likely applies more of a formulary apportionment, and not all countries agree that the formula agree on a formulary approach, or would accept potentially rough justice to the group-based allocation based on a formula. Group-based taxation may include a tax certainty process that means certain allocation of incomes or decisions on nexus and the paying entity are made outside the sovereignty of individual countries. And again, that's something that I think that not all countries, or maybe even many countries, are currently comfortable with. So it is true that some NGOs and some academics advocate a group-based taxation and formulary apportionment. However, as noted, my personal view is the sovereignty issues and the current infrastructure and framework of the international tax system means that the separate legal entity approach will maintain primacy in the coming decade. So, however, we have seen with Pillar 1, there is a desire by the inclusive framework and NGOs and other supranational institutions to want to reallocate more income to market jurisdictions where the users and consumers are located. And this can be achieved in various ways, including withholding taxes and digital services taxes and concepts such as digital PEs that some countries have advocated, and fractional apportionment models. And all these mechanisms seek to reward the market jurisdictions more than they are rewarded currently. And this is essentially what Pillar 1 is also seeking to do, but on a group-wide net income basis versus a separate entity gross or net income basis. And let me point out a couple of key features of Pillar 1 that have been designed to ensure that Amount A acts as an overlay to the current separate legal entity system. And you'll hear me say that a few times today, the overlay. So Amount A adopts a group-based approach, but would only apply to a limited pool of in-scope businesses, e.g. ADS plus CFB. businesses, it would only apply to residual profits. So further limiting the businesses impacted and retaining the primacy of the separate entity approach, which would continue to tax routine profits of separate legal entities or PEs. So as noted above, Amount A would only apply as follows. We have step one. We've got the current TP and transfer pricing and permanent establishment profit allocation rules, which will continue to apply to allocate net profits to entities. Step two, after entity level taxable profits are calculated, Amount A is calculated on a group or segment-wide basis and only seeks to include a portion of the residual profits of the group. And step three, Amount A is paid by entities within the group that have been identified and have the ability to pay residual profits to the market jurisdictions, or at least the eligible market jurisdictions. So accordingly, I guess the taxation of only a portion of the residual profit seeks to ensure that the separate legal entity approach is retained as the core foundation of the international tax system. However, I mean, realistically, and this is the reason why we're discussing this today, there are areas of overlap and tensions that need to be dealt with as the Amount A group approach plugs back into the separate legal entity approach and the separate legal entity system. And it is the identification, in my view at least, that is the identification of the paying entity and the payment of Amount A from this paying entity that is the element that is fraught with tension. Why? Because this is where the separate legal entity approach and group approach actually interface. And specifically, an obvious tension area is in relation to the elimination of are the areas of elimination of double taxation and double counting. And that is ensuring profits in the paying entity are not double taxed under Amount A. And we see this areas of tension, including withholding tax. So we have an entity which has already paid withholding tax on royalties, but then also has to pay withholding tax under Amount A. And another area which has been raised by some of the panelists, which I've had discussions with, include decentralized businesses that already leave residual profits behind in the market jurisdiction and then have to pay Amount A. So further work needs to be done in this area around the development of the marketing distributor safe harbor and the potentially a domestic to domestic exemption to ensure there isn't a double counting of residual profits, particularly under decentralized entities. And so this is obviously an area of continued focus and work, and we heard this a lot in the submissions and the public consultation on Pillar 1. Sorry, on the slide. Other areas of tension include relying on consolidated profits. And so relying on consolidated profits under the group basis will widen the traditional gap between financial and tax accounting. The consolidated financial statements will likely show a result, either whether it's profit or loss, which is different from that which could have been resolved or derived from the aggregation of the profits or losses computed under tax law applicable to specific members of a group. And as already discussed, the current international tax system and corporate tax regimes are premised on the single entity approach. So the additional layer on top of that of Amount A would represent, I guess, and create different administration and compliance requirements. And I've already mentioned some of the complexities around double counting. Entities identified as paying entities will experience the biggest tensions as both systems coexist in potentially, or at least potentially coexist in the future. So formulaic identification of taxpayers that may actually not derive residual profits. And this is some of the discussions we've been having in the inclusive framework, where some IF members or inclusive framework members prefer very much a quantitative approach to identification of the paying entity, versus a more transfer pricing approach, a qualitative approach, which is seeking to almost identify residual profit owners as we do under transfer pricing. We think a formulaic approach, while simplifying, potentially creates situations where you've got paying entities which may actually not actually have residual profits. For example, you could have a cost plus entity which makes cost plus 15 and therefore is actually above the profit level, but is actually a service provider and doesn't actually have residual profits, as an example. So that also goes to the fact that there a lack of economic and commercial rationale of some outcomes, such as when the identified taxpayer has no functions, assets or risks relevant to the eligible market jurisdiction. And this goes to the point, an area of tension we've had in the inclusive framework, which is where you have a paying entity in a market jurisdiction which is eligible for an Amount A, but no market connection. And so that market connection creates very serious tensions for some members who are sort of suggesting, well, I'm comfortable to pay Amount A, but to jurisdictions where I actually am deriving residual profits. And so that's a very serious area of tension that we need to contend with. I think interactions between parallel systems regarding, among other things, the computation of losses. So that could lead to unfair situations where, for instance, carry forward losses at the level of the taxpayer cannot be offset against the Amount A liability. And that's quite a serious issue for some members as well. So these are all, and I only mention a few, but these are all problematic areas. And as noted in the slides, they're really important elements that need to be resolved. And obviously the elimination of double taxation process needs to ensure that profits are taxed only once. And so, for example, as I've mentioned, these include ensuring as much as possible the paying entity is a residual profit owner and has the ability to pay Amount A. That the paying entity is receiving residual profits from a market jurisdiction that it's connected to. And as I've mentioned, that's quite important for some countries and also some businesses as well. That the marketing and distributor safe harbor will help by reducing the number of businesses that actually need to apply the elimination mechanism. And that is, if we do have a marketing distributor safe harbor, that means we can connect, some businesses can continue to use the transfer pricing mechanism to actually pay Amount A and take some of the pressure off identification of the taxpayer. And lastly, inclusive frame members have different views on elimination, but we believe we can and we need to find an acceptable compromise solution. So, and also, so can the two systems exist? Can the two systems exist into the next decade? Is it possible? Well, if it is, it seems clear that the only way to do this is to minimize disputes. And as noted on this slide, this is even tough enough to do in the current separate entity approach, for example, with PEs. And this is something that needs to be addressed, I think, by two aspects. So number one, seeking to simplify the Amount A framework and rules as far as possible using formula where possible. Number two, providing a tax certainty process that is focused on both early certainty and administrative ease. For example, having an early certainty process for Amount A that seeks to provide early certainty on scope, nexus tax base elimination, and an administrative process where there is one nominated paying entity, for example, such as a paying entity being required to read, and that will stop potentially this spillover effect issue, another tension where you've got paying entities having to register in market jurisdictions and file tax returns, which actually may create PE issues in those market jurisdictions. And so more importantly, we are exploring ways, and we mentioned this in the public consultation, to reduce tensions in the existing separate entity system that impact the group allocation of Amount A. So for us, we refer to that as tax certainty beyond Amount A. And so For example, if a subsequent transfer pricing adjustment or PE claim means less amount A in a jurisdiction is required to be paid, then we need an early certainty process which actually deals with that. Because if we have if we have 2 to 3 years later after a tax tax return's been filed, and then we have an audit and a subsequent adjustment for transfer pricing or PE, that will impact the amount A required potentially to be paid or received. And so that needs to be dealt with. And it's very clear to me, at least, that undertaking retrospective amount A adjustments is unacceptable to inclusive framework members. And so accordingly, it's a tall order, but if we can reduce disputes and with the introduction of amount A and tax certainty and early dispute resolution, that will be very important to the coexistence of the two systems and the interaction of transfer pricing and PE with amount A. Let me look at the next one. What about alternates apart from Pillar 1? This is just a sort of note that I don't think the Pillar 1 stands by itself in terms of a group approach, and so it's also worth noting that there are other alternates to applying a group approach. And this slide lists a few. For example, digital services taxes are either group or gross-based approaches to taxation, and they've been adopted by 36 countries. The rule around PEs, permanent establishments, and profit attributions are complex and are sometimes used to assert taxing rights that are akin to group-based taxation. And we see that in certain jurisdictions. India's fractional apportionment proposal and the G24 SCP proposal. So there's a broader interest in these types of approaches. And so where I sort of end up here is, in conclusion, there is some form, in my view at least, some form of coexistence between a single entity versus a group-based approach to allocating profit seems likely in the next decade. And that could be Pillar 1, or it could be one of the other systems mentioned on the previous slide. It seems clear that some countries and some institutions prefer a shift along a path of group-based taxation. And it also sort of seems clear as well, some institutions seem to prefer a wholesale shift to group-based taxation, but this may not be feasible. Others want to stick exclusively to the single legal entity approach, but it also seems that that may no longer is no longer clear as well, and that's not something that all countries are willing to accept. So how do I end up in this? Perhaps amount A can be considered a more balanced approach, a consensus solution that doesn't discard one system nor wholly take up another system. Rather, it could be seen as a coexistence of the two systems, and maybe even as a necessary compromise between inclusive framework members. So as noted, it's not clear the interaction between it's clear that the interaction between the two systems does create tensions that will need to be primarily addressed through the mechanisms to eliminate, in my view at least, double taxation. And that includes identification of the paying entity, dealing with the issues of double counting, and then obviously the early certainty process as it relates to subsequent transfer pricing and PE adjustments. And as I've mentioned, there doesn't seem to be much appetite for retrospective adjustments. So we really think that will need to be dealt with in the early certainty process. I can see Professor Danon smiling there, because that will be incredibly complex, I know. But I wanted to again thank the university. I want to thank Professor Danon and Professor Chan for the opportunity to present on this today.
Thank you very much, Matt. Just of course, as you probably have seen, you all in the program, we have a separate session tomorrow on the discussion of the Pillar 1. and some of the issues which you touched upon will be picked up in 2 case studies with the panels. We have a little bit of time before we hit the next session. So I want to take the advantage of having the speakers with us now, perhaps to see whether there are a few questions that you wish to address to Matt to continue the discussion a few minutes. I have a few, but I will save them until to give priority to some of you. I don't know if anyone has any question, follow-up question further to what Matt has presented very well.
Yes, I think, Robert, if I may take this opportunity and ask Matt on one particular point, just to, I think we shall have a chance to discuss that later on the ramifications of the Pillar 1 work, is the relationship between the tax profit and the accounting profit, the extent to which this subject and issue is ranked first or second among the several issues that you have addressed. And there is I have several reasons for considering this issue as a number 1 issue, is because in many countries you have either tax profit which is entirely detached from accounting profit, or in some other country you have precisely the other way around. So you may have different reactions by countries. And second, the manipulation, if I may use that expression, of the accounting profit, if that is going to be the relevant profit, which is also the reason for which you have departures from the accounting profit in tax legislation of almost all countries. If I take a provision for risk, for instance, I make stakeholders happy because I am prudent, but obviously I make a revenue agency less happy because I have a lower profit if I were to take that approach. The third point is segregation of domestic profit vis-a-vis foreign profit, because basically in the accounting, then the tax profit domestically would rely on rules which are different from accounting compared to the profit which I have to compute for the Pillar 1 methodology. So if you could just, you know, I'm not asking a large, let's say, presentation, but I'm curious to understand what your reaction is. Thank you.
Thank you, Mr. Maestro. It is a very, very good question, and I think it sometimes gets a little bit overlooked, as you've mentioned, because of, I think sometimes we jump to the issues of segmentation, which are quite complex. But you're actually right. This is an area where we have a very specific work stream on, because we are aware that, for example, JGAAP and Japan GAAP versus US GAAP versus KGAAP, Korea GAAP versus IFRS do come up with some significant differences in the treatment of book-to-book adjustments, and whether that's amortization, for example, or depreciation. There are differences in there, even in terms of the first step, which is consolidating the group consolidated profit level. At the moment, I think we're looking at that. We're looking at some of the sort of more material issues or adjustments potentially, or impacts, items which will impact, to see whether we actually do need to make adjustments of that, and potentially we do. I think some of the IF members would sort of see that they don't want to make any adjustments from a simplicity perspective, because once you start doing that, you create your first layer of complexity. The second issue, as you've mentioned, is the accounting to tax, and we do recognise as well that there are certainly different treatments of different types of comprehensive taxes, treatment of joint ventures, for example, and the treatment of other items. And we think we are going to need to make some adjustments in terms of the book to tax adjustments to get some reconciliation of that. We didn't touch on that as much in the blueprint, but that's certainly an area which we are looking at very, very specifically and are taking very seriously. It has been raised, I would have to say, by some of the European Union countries, including Switzerland, for example, including Austria and others who are quite concerned about that book to tax adjustments and what should be included and not included. Again, I think there is this tension between the technical accuracy versus the political simplicity, the call for simplicity. But we are aware of that and are looking to across the different types of major gaps. And we are looking at the major gaps as a way to sort of say, these are the likely jurisdictions where we will be consolidating under US GAAP or IFRS or Japan GAAP or China GAAP or Korean GAAP, who are the major companies potentially impacted by this as the consolidating point at the moment and are doing work on that. So all I would sort of say to you, Mr. Maestro, is we are currently working on those issues at the moment. I think, in my view as well, it's actually probably number one, because if you don't get your tax base right or get it even, for example, in terms of fairness or level playing field, then everything else follows from that. Your segmentation follows from that. Your PBT, profit before tax, follows from that. So for me, that's a very, very important issue as well.
Thank you very much, Matt. Indeed, for Switzerland, it would be indeed very, very relevant as well, given that we stick to the accounting figures subject to certain corrections. I don't know if you have, anyone has further questions or comments. Vikram, yes?
Yes, actually, just another question to Matt is in relation to the surrender entity and the method that is going to be chosen with respect to relief for amount A. So there are basically two methods, exemption and credit. And in the public consultation, the commentators have voiced, especially the businesses, have voiced their opinion for an exemption method. And the exemption method has the potential to actually not only provide relief from amount A, but actually reduce the existing corporate income tax base under the separate entity approach. And I just wanted to hear a bit more about your thoughts on this, on what is the method that is currently being preferred by the members of the inclusive framework in general.
Yeah, I mean, it's another really, really good question. In reality, I think it's hard to put my finger on it, Professor Chan, but I think, as you've mentioned, I think not only from a public business perspective, there seems to be a preference for an exemption. I would sort of say there tends to be sort of perhaps a majority of inclusive framework members who also potentially see the exemption perhaps as the simpler approach to relieving amount A. However, it also seems clear to me, Professor, that there are also a number of quite important constituent countries which are very committed to continuing with the credit method, and so where it sort of seems to me in terms of as a secretariat we have a view on this, and from a simplicity and administrability perspective, but it seems clear to me at this particular point in time where we are with the development of the blueprint is that both options potentially will be available to business. And that's because IF members have quite specific views about why they prefer the credit method versus the exemption method. So I think at this point, both will be available.
Yeah, I think this is a very good point indeed. And of course, there is the simplicity aspect, but as you mentioned, the credit and the exemption method are rooted in fundamental different policy.
Yes. Yeah.
So I can understand that certain countries wish to stick to
Yeah, and we will need to, I mean, this is an area where there is quite significant further work. So we'll, as I sort of say, in my view, this is where we are right now. We'll obviously need to continue this discussion from a business perspective, but also from an eye perspective to sort of see where we actually end up with this. And I agree with your point. I mean, there are variances which come out, which I think will need to also be need to be brought out with further consultation with IF members and business.
Yeah, thank you. We have a question from the audience, which I will take. There's a question by Lagarde, and the question is as follows. Given the very well highlighted critical issues, where does the belief come from that the practical difficulties, example, organizing the tax collection, auditing amount A determination, and most importantly, dispute resolution, can be resolved by a way of compromise over the upcoming months? And does that mean that Pillar 2 considerations, probably more simple in many regards, are off the table? So this is quite a complicated question, but yeah, Matt, the floor is yours.
Yeah, look, I think it's a really, I mean, obviously it's a very good question. And so to me, I think the reality of having to get to, I think, serious push for a consensus solution in the coming months really means that we are going to have to look at, when you step back and look at the reality of the implementation and the administration and then the early tax certainty process, it seems clear to me at least that many businesses who are potentially within the scope of Amount A are going to want early certainty in relation to scope, nexus, tax base, elimination of double taxation, etc. And that means we have to look, I think, at some of the thresholds, quite seriously look at the thresholds in terms of what is realistic. And you know, sort of like some months ago, I did an exercise. I happened to sort of be one Sunday afternoon when I was sort of going through what are some of the key questions that businesses will need to look at in terms of getting early certainty, whether it's the sort of they're in the scope or there's domestic exemption or they have to sort of segment. If they have to segment, can they use disclosed financials? If they can't use disclosed financials, what are the hallmarks? And there's approximately around 40 plus questions which would need to be answered. And so in order to do that, and in order to also identify a single paying entity, I think that also means, you know, potentially realistically looking at sort of thresholds to sort of get to a manageable number of entities which would need to, number one, be within the scope. And then number two, also have to segment, because segment, in my view, is where a lot of complexity actually comes. And so I think looking realistically at thresholds, agreeing with the IF, this is the constituent number of entities we can get through realistically, early certainty, I think will actually drive a lot of the implementation and the discussions in the coming months. Because to me, that's a relatively finite number in order to actually make this work from a, number one, an administrative perspective, but number two, from an early certainty perspective. So that's kind of I'm using a roundabout way of sort of saying I think we are going to have to look seriously at threshold to really understand the constituent numbers to make this workable in the first years of actually implementation.
Thank you very much, Matt. We are getting other questions. We will try to pick them up in the panel on Pillar 1. I see that some attendees are actually requesting numerical examples. So to give a few numbers in the Pillar 1 panel, but I think it's time we move to our next discussion. Once again, I really wanted to thank you for taking the time. This is just a milestone in the discussion, but of course I get the feeling that we will have other pleasure and other opportunities to debate, because the project is far from done and over. And as you pointed out, a lot of issues need to be addressed both at the policy and technical level. But thank you so much for joining us. It's been a pleasure to have you. So
thank you.
Well, we will move to the next session. Let me introduce perhaps the purpose of this session. We thought that it would be nice to have an umbrella session aiming at looking at the issue of profit allocation from a strategic importance and from the perspective of tax in the boardroom and also wider ramification. What I would like to do essentially, and I will introduce the panel in a few seconds, is basically to look at the current transfer pricing landscape and see what it means for business, see what it means in terms of certainty, and also, of course, in terms of the increasing necessity to communicate with boards of companies on tax issues. And there I would like to take a first round of the discussion to explore the issues from the perspective of the current framework, not the future framework, the Pillar 1 framework, but simply how are we coping with the current transfer pricing landscape, typically that stems from the BEPS outcome, the DEMP functions, etc. So I would like to organize the panel as follows. I'll take a first round of comments, and then we will move to the second item, which is the Pillar 1 discussion, which is more perspective, but of course raises already a lot of issues from the perspective of corporate tax governance and so on. And then we'll also take a wider perspective. And there, I think there is an interesting question that will be raised by Guglielmo Maisto, namely some interaction with the Tax 6 directive. So let me introduce the panel. So you have myself, Vikram Chand, Guglielmo Maisto, and Jean-Louis Guerre, who is the group head of tax of Nestlé in Switzerland. So perhaps let me just start with a few questions on the current framework. One of the outcome of the BEPS initiative is, of course, the work on BEPS Action 8 to 10, the DEMP functions. The question now is, if you balance this work with tax certainty and predictability, how do you see this impacting governance issues, planning issues, certainty issues? Is the current landscape satisfactory from this perspective? How do you see the role of safe harbors in this context? What's your assessment of the current transfer pricing landscape in particular? And perhaps to kick off the discussion, I will give the floor to Jean-Louis.
Thanks. Good morning, everybody, and very pleased to be here with you. Yes, obviously very interesting questions on the current landscape. But first, to go back to the key question of this panel about the interaction with the board, which is also linked to your question, Robert. I think that we've seen an evolution in how the board is looking at basically the tax affairs of the company. Not only the executive board, but also the full board, and also the statutory auditor, who has basically put the tax as a key major audit item over the last years. So they have indeed a deeper interest in taxes. So basically, they're interested in the following questions. First, are we in compliance, which is normal, and do we pay our taxes in the countries where we operate, in line, obviously, with the economic reality, which is also, which is directly back to profit allocation, based on the traditional method, the separate legal entity method, and also basically BEPS 1.0 modified that indeed. Also, they want to understand what is a long-term tax strategies and priorities, and is it in line with the business strategy, as well as with the corporate value and business principles, which is also back to profit allocation, and how basically through transfer pricing, we allocate that profit to countries and legal entities. And then the final one is basically, is our effective tax rate and all the taxes that we pay sustainable, also predictable and responsible, and can we explain it internally and externally in our tax journey to a tax transparency, which is again back to profit allocation. So basically, this has been more and more at the core of the engagement with the board and with the other stakeholders, internal and external, is beyond the transfer pricing policy one by one. How can we justify and explain this allocation of profit at the legal entity, at the country, but also at the group level? And that has changed dramatically the type of engagement that we have with the board. And that changed also the way that we reconcile the effective tax rate and the allocation of taxes among the group. And that's a difficulty that we've seen, and BEPS 1.0 obviously have modified this. And since then, we had to review basically the key transfer pricing policies that we had, which we have done mostly now, and as well as basically how does that impact the profit allocation.
Thank you very much. Jean-Louis. Guglielmo, I don't know if you want to add anything on the current framework.
Yes, indeed. Just making a reference to what Jean-Louis mentioned, we also see a change over time in the last few years in the relationship between the tax function and the board, especially in the area of transfer pricing for the reasons he stated earlier. I would add also the reputational aspect, especially when a transfer pricing case, which generally involves significant amounts, comes to the press. And so there is an alert and much attention by the board on the ramification that the transfer pricing policy may have. So more and more frequently, we see also presentations which are made by the tax director or the CFO to the board, just high level, but just to have an overview in connection also with the tax rate issue, which frequently the press is looking at when presenting a profile of a particular group. Second aspect I would mention is that this attention is even more acute when the group is in a regulatory business. You can look at banking, insurance, or pharma business, where the transfer pricing practices obviously have ramifications on either the relations with the government or the authorizations or other regulatory aspects. So I believe that I concur with Jean-Louis' opinion that there is more and more attention of the board to the transfer pricing matters.
Thank you very much, Guglielmo. And indeed, you mentioned the reputational aspect, which of course plays an increasing key role. Perhaps, Vikram, a few words on the current framework. If we look at the outcome of BEPS 1.0, one of the outcome, of course, is the work on BEPS Action 8 to 10, the DEMPI function. How is your assessment of this outcome in terms of tax certainty?
Thank you for the question. In terms of tax certainty, I think the DEMPI concept really ranks really low in terms of providing multinationals with tax certainty. What I mean by that is that the way the DEMPI concept has been formulated is a quite open-ended concept. The issues are, when I talk about multinational business models, so if you take a centralized business model, probably if you have all the key decision makers sitting in the centralized entity, then the issues with respect to the DEMPI concept are a bit low. They're still there, but they're a bit low. But when I compare the application of the DEMPI concept to decentralized models, where especially, for example, if you have an entrepreneur in Switzerland and which is operating with another entrepreneur in India, for example, a Swiss entity which has a subsidiary in India, which is a full-fledged manufacturer or a full-fledged distributor, then the application of the DEMPI concept there becomes even more challenging because both countries here can actually argue for a higher return for profit allocation, especially profit allocation stemming from intangibles. So from a tax certainty standpoint, with respect to decentralized models, the DEMPI concept in providing tax certainty to taxpayers ranks really low. And I personally feel that when multinationals are setting up decentralized structures all over the world, the only way to get upfront tax certainty is through APAs. There are many models which have been put forward in literature, to provide some kind of clarity around the DEMPI concept, for example, the RACI or the RACI model, so on and so forth. But all this is very nice and sweet, but the only way multinationals can get upfront certainty in the current framework is by having more bilateral or multilateral APAs. So what I personally feel is that there's going to be an outburst of bilateral APAs or multilateral APAs in the following years to come.
Can I react to this, Robert and Vikram? I totally agree with you. And that I think is also, I know that some companies have used APAs and bilateral APAs much earlier. But indeed, I think that since the BEPS work, I think that more and more companies have used them, bilateral APAs. And we have used them, and we have a huge program on bilateral APAs with more than 25 countries now. But at the end of the day, even if you go to bilateral APAs, you're still back to the same questions about, yeah, it can provide certainty, but still the uncertainty in the current tax system is still there, and you still need to address it as part of the MAP process, the APA process. And at the end, in those critical APA process, we are again back to profit allocation more and more. Not that much from a one-sided effect, but more than two-sided, even on the total group basis, because competent authorities are interested to see, even beyond the specific transaction that you want to settle, they want to see basically the total interaction of the total transfer pricing policies and basically the group allocation. So we are already in this world where this uncertainty is there, and at the end it's profit split. And yes, bilateral APA is something, a critical tool for that. But I still believe that despite the bilateral APAs, we're still in this uncertain tax world, and that will continue.
Yes, thank you. I think this is a perfect closing remark to move to the next part of the discussion, because you said that we're living in the world of uncertainty. So now I will perhaps ask you, Jean-Louis, if we have the add-on, if we have the pillar one and the amount A to this current already shaking environments, how do you see it in terms of communication with the board, in terms of the MNE strategy? How do you see it? What are the main issues at stake?
Right. Yes, very interesting question, obviously. And yes, we had already some discussions with the board on pillar one and pillar two. And yes, it's very difficult to explain to business people, especially to the top management. And yes, I always appreciate to listen to Matt, because when you listen to Matt, it seems that it's very economically speaking, and it's very easy. And I really like the example of the Kiwi company and the French company. I don't know why Kiwi, probably because Matt has a close connection to New Zealand. But when you have to explain it to the board with a group like Nestle, where we pay taxes in 150 countries, and to explain the concept that we might have to reallocate part of the profit to countries where we have no business presence, but we sell our products, or we sell through independent distributors or through limited distributors. It is a very difficult concept, and also it creates unpredictability on the effective tax rate, because year on year it can change. And we are privileged that if indeed the pillar one goes on and consumer-facing businesses are in, we will be in on the total business of Nestlé. So no escape through scope and whatsoever. So it does create a big uncertainty. But back to what I said, that will force us to re-explain basically to the board and to stakeholders that now we have to explain and reconcile our footprint and our taxes at three levels. The first one is the traditional separate legal entity approach. So by legal entity, based on the classical transfer pricing and based on the classical basically planning and models and whatsoever. Then the second one is still this BEPS 1.0 country by country report, which is already a bit higher. It's another dimension on which we haven't really yet drawn the conclusions, but it gives a different view country by country about where the functions are and where the profit is allocated. And then there is now this third level, which is really this group profit allocation with Pillar 1, where you'll have to explain basically how you allocate the profit on a total group, total value chain basis, and what are the key value drivers for that, which is also back to a kind of DEMPE function, but at a total group basis based on your HQ, footprint, business drivers, and so on and so on. And so you have this bottom-up approach to the traditional one, and then you have this new approach, group profit with Pillar 1, which is more top-down, and you have to reconcile it and be able to explain it.
Thank you very much, Jean-Louis. And just perhaps a follow-up question to you before I turn to Guglielmo. How promising you feel safe harbors and formulaic approaches will be in simplifying the system?
Well, we still hope that indeed it will be simple and easy to implement. Although I doubt about it because the complexity of the business is such that even if we manage to simplify further the approach, I still believe that it's going to be pretty complex. The question raised by Mr. Maisto, and the discussion with Matt explains it, is this tension between accounting and tax. And by the way, it's not new. It already exists in the current system, because in the current system, what drives the major differences in taxes today is basically the differences in accounting and the differences from accounting to tax country by country. When you do the effective tax rate reconciliation at the group level and then down by country, that's where it is. And that's where basically also countries use that as a tool to attract more taxes, more profit, even fictitious profit to their countries through this accounting to tax manipulation. And so I think that going at a high level on IFRS, I think probably it's a solution. And probably I would even say that a big simplification for me would be that if the large multinationals subject to Pillar 1 and Pillar 2 could even move on an IFRS basis, even for local corporate tax compliance, so that we would have a full alignment between the first level, so the local tax compliance, and this new level of Amount A Pillar 1, starting from IFRS with some common, basically book to tax adjustments.
Yeah, thank you very much. Guglielmo, you want to react to this on Pillar 1?
Yes, indeed. I believe that I am intrigued by a number of ramifications of Pillar 1 and the difficulties that the OECD has not yet considered in depth. We mentioned the accounting profit when we had the chat with Q&A with Matt, but he also mentioned withholding taxes, for instance, and that takes me to two comments. The first one is interaction with tax treaties. I don't think that the blueprint is addressing that significantly. That is going to be quite an issue in relation to precisely the provisions that Matt mentioned, Article 5, 7, and 9. Particularly, I would say Article 5, because then you need an alignment perhaps on the meaning and interpretation of permanent establishment. And also the withholding taxes, because the treaties are bilateral, and to have better bilateralism combined with the Pillar 1 is going to be very difficult, I think. So that is something that would need to be addressed. Second aspect I would like to mention is the ramifications that the Pillar 1 system may have on taxation of a business, perhaps of the same group, which is not covered by Pillar 1, and the attitude of tax authority during audit, because we are moving from a single entity approach to a group approach, and that, I believe, is something that might be used by tax authorities also during audit or vis-a-vis groups which are not under the Pillar 1, let's say, methodology. And we have to consider that the world is not made only, and the profits that overall have to be taxed in the world are not only made by companies or groups which fit into the Pillar 1 if the threshold is going to be set very high, as I would expect, because the system is so complicated that only large groups, very large groups, could handle the, let's say, red tape which is required. So if you look at companies and groups which are below the threshold, we are talking about a very large size of profit, and the taxation of such profits may be affected by the Pillar 1 concepts. That is something that we would need to consider, tax authorities would need to consider, and the legislations would need to consider.
Thank you very much. Guglielmo, since you have the floor, I think we can conclude this this first session with a few thoughts that you had planned to give, and namely the interaction with DAC 6. Guglielmo? We cannot hear you. Sorry.
The line was disturbed.
Oh, sorry. I think you wanted to offer an additional perspective also on the interaction with DAC 6.
Yes, I believe that another ramification I would consider is the divergence between OECD and EU work. It's precisely yesterday that the European Commission published in the inception impact assessment, namely the future work and the proposal that it would make to the Council on the digital levy. And that indicates that the European institutions are not ready to wait much longer. And indeed, the Council of Ministers already in July of last year announced the intention, the political intention to have the digital levy as one of their own resources. And this move, which indicates a proposal to be made by the Commission to the Council by June, may indicate some issues of interaction between what the OECD is doing and what the European institutions are doing. The European institutions have also different, let's say, restrictions when they're dealing with the digital levy. And so I think that the real challenge shall be how to coordinate the two. We have already a sign of the frictions between EU policy or rules and OECD rules. You anticipated my comment on the DAC 6, which indeed makes a reference to some hallmarks for transfer pricing, which create obligation of reporting. And one in particular I would mention in terms of possible frictions with the CD is the hard to value intangibles, which are basically the methodology on how to assess how to value intangibles with reference to the post-transfer results. And there, if you compare the OECD guidelines saying that you don't need to apply that methodology when you have an APA in place, and you compare with what the DAX 6 requires in the hallmarks, which requires reporting in relation to actual value intangibles, there seems to be a friction. So that is an example of a situation where you have OECD guidelines on the one hand, and the desire of the EU institutions to have its own rules, and sometimes you have friction. So on the pillar one, there is an additional complication for the OECD, namely to find, let's say, a compromise with the EU and the consistency with the forthcoming EU Digital Levy. And they call it levy. So in the document which was published yesterday, they don't call it tax, they say it's a levy. So just to show the difficulty that they have in characterizing what they call to be a tax, but that is something to be discussed at some other time.
Thank you very much, Guglielmo. Indeed, I think the interaction between the OECD and the EU work is not new. We have seen this also in the BEPS.1 phase with a lot of compatibility issues. Now we have political divergences, as you pointed out, a different also agenda, eagerness to move fast. DSTs, as you mentioned, raise other compatibility, possibly even with tax treaties. I have a question with from the audience that is related to your question that I will read. It says, well, the person agrees with the EU OECD divergences, but, and it's addressed to you, do you think that the EU Council is going to pass the proposal as unanimity is needed? It could look like they're going to create a catch-22 situation.
Well, it's difficult to predict on unanimity and on what is going to happen at the EU level. We have to consider that the digital levy was proposed already and did not find unanimity, not at all. There was opposition by a few member states. So it's surprising the political, let's say, commitment or statement made by the Council about having a digital levy. The point is, I think, that on political statements, member states are aligned, but when you come to actual approval, then all the issues come out and agreement evaporates. So I am a little skeptical about the future of such EU digital levy because I don't think that the EU can actually, regardless of unanimity, go on its own way without taking into consideration the ramifications of the Pillar 1 methodology. So at the end, they shall have to follow and adapt their own legislation to the position of the OECD.
Thank you. Thank you very much, Guglielmo. I think we're reaching at the end of the panel. I don't know if Jean-Louis, you have a...
Right, maybe a last point. Reacting to the EU, I think that, yes, indeed, it seems that they have the willingness to go ahead. But honestly, I believe that it's extremely dangerous. First, because other countries will be then incentivized also to go for the digital levy, which is going to be even a bigger mess than what we have today. But also now with the OECD and Pillar 1, we already, I mean, the Pandora box is already open. So countries, if we don't find a compromise on amount A, countries will implement their own version of Pillar 1 on a unilateral basis, and it's going to be even a bigger tax chaos. So I think that we're going to end up with the worst of this tax world, where we'll have no basically compromise. Every country will go after their own piece of the cake through digital levy, whatever, through amount A, through whatever. and it's going to be even much more uncertain and much more unmanageable. So, but back also to the discussion, I think that we have to, I agree with Matt that we have to accept that indeed we are moving to a new world, in this kind of hybrid new world, where the separate legal entity and the arm's length principle will have to coexist with this new group economic approach. And we'll have to find a way where we have to build a compromise internationally. There is no escape.
No, I would support this. I mean, there is clearly a need to minimize disputes, achieve tax certainty. And if you think about it, the separate entity approach is such an old concept. I mean, to be able to basically move away, even partially, from the separate entity approach with all what it entails, namely an add-on, is already a huge step forward. I personally feel that this is going to be just an intermediary approach, and this is not the end of this is not the final destination. But if the intermediary approach is able to switch off some of the chaos that may come around, because remember in the past we talked about the Pillar 1 discussion versus the STs. That was the main debate. Now what you're saying is even worse. I mean, you could have the OECD Pillar 1 versus unilateral Pillar 1 by some countries, plus the STs. From an MNE Group and back to the question of corporate governance, it becomes a chaos in terms of predictability. And no matter how good we are on dispute resolution side, we will be facing quite significant problem, compliance costs, disputes costs, and so on. The other point that we did not touch upon, of course, and it's in the shadow, is the future position of the US administration. I mean, the new president was sworn in yesterday. Perhaps just a closing comments to all of you. How do you see the involvement? It's really crystal ball to speculate at this point, but just I would be interested to have your guess. How do you see the US position moving forward, and how do you see the impact of the new administration? Will it change? How would it affect the current debate? Perhaps Guglielmo and then Jean-Louis.
I believe that the new administration might find a compromise with the OECD and also with the EU, because the EU, as we know, there were frictions which were related to the Trade Act and so to customs, and so there are several ramifications. And if we look at the program that was announced even prior to the elections, I believe that there is a prospect for a compromise between the new administration in the US and the rest of the world. I think it's a policy which is not related to tax only. And if we go back to multilateralism between the US and other countries and or organizations, I would be rather positive. Maybe it's not easy, but it's doable. That is my view.
Jean-Louis and then Vikram, perhaps?
Yes, I do agree. Indeed, I'm pretty optimistic that indeed with the new administration, there will be probably more room to find a compromise. And hopefully there will be one, because I believe that it's absolutely important. Yet, I think that the US has also changed. So I don't think that we will go back to the pre-Trump years so easily. And I think that they will defend their interest and their stakes. And they'll make sure that the US as a major economy with high innovation and R&D and so on, and obviously having a huge impact on the digital economy, but also on consumer markets, will have their fair share. So I don't think there is going to be a free lunch for for the OECD and the EU and the other countries. They'll negotiate their side of it.
Mm-hmm. Vikram?
Yes, so actually I've been following the American politics quite closely, as you know, since the past few years. Under the Trump administration, I would have been highly skeptical that a Pillar 1 solution would go ahead, but under the Biden administration, because they favor more multilateralism in nature, I would think they would participate in the discussion and they would somehow come to a compromise. But like what Jean-Louis had mentioned, I would still think that the compromise which they would agree to would be mostly in favor of American multinationals and not for developing or developed market countries as such. So I would think that under the US administration, the reallocation percentages that will be argued in favor of market countries, they will try to keep it as low as possible, whereas the developing countries would want a higher stake, or market countries would want a higher reallocation percentage. So it'll be interesting to see how this discussion would develop, because the US would like to give as little as possible, but the other countries, the market countries, would like to take as much as possible. So a compromise has to be struck at some point in time, and it will be interesting to see what this compromise is going to be.
Perhaps, but this is a guess, that in the deal baskets, in the end, you may need to take additional measures for developing countries to basically pass the Pillar 1 discussion. I mean, but this is just a guess. Okay, so I think we are a bit now behind schedule, so we have to end the discussion. I'm really honored to have been part of such a great panel. I want to thank everyone, in particular Jean-Louis, for taking the time. I think we raised a lot of questions, but we did not provide many answers. But it's difficult to do more at this stage. But I think what we achieved the objective, namely to show that transfer pricing is just a technical issue. It's a problem that is at the frontier stage of the discussion between MNEs and their boards. It has a lot of non-technical ramifications, such as the reputational aspect. So thank you very much for this. And we will now move to the second part of the conference. So thank you very much to you all. And we move to the second part of the conference. Perhaps let me give you an outline of what we will be discussing until lunchtime. I see that lunch the lunch break will be at 12:15. So we'll be beginning with a session called Transfer Pricing Disputes, a Lead into the Debate. This is also another umbrella topic. And then we'll have a targeted session up to 12:15. So we'll have a first session that will be chaired by Aurelio Massignano, who is a partner with Maisco and Associati, on intra-group services transaction. Then in the afternoon, that will go on until 12:15. And then we'll have intra-group intangible transaction, and finally intra-group financial transaction. The idea here, of course, is to take a more transactional and targeted approach on some of the outcome and impact of the current transfer pricing framework. And then finally, if you're still with us until the end of the day, once we've dealt with the separate entity approach, we'll move to attribution of profits to permanent establishment. Very nice also session. So perhaps just to enter the first session, transfer pricing, a lead into the debate. I think I will turn to Vikram and to Valerio. Vikram, I don't know how you're gonna play this. Would you like to start first, or shall we give Valerio perhaps the floor?
Well, I will keep my comments very brief once again. At this stage, what we are going to do is we are going to get into a bit more into the transfer pricing issues that you see within the separate entity approach. So the bulk of today, the rest of the day, we are going to focus on the separate entity approach. And tomorrow we are going to come back to the MNE Group approach. With those few words, I would request Valerio to kindly share the slides and please start his presentation, which would give us a nice lead into the entire transfer pricing dispute debate.
Yes, thank you, Vikram, and thank you, Roberto, and I would like also to thank the University of Lausanne for inviting me to this very interesting conference, at least so far. Yes, I will share, if I am able to, my screen, and we would like to engage in a debate, in a discussion on the current status of and in the development of transfer pricing disputes, and in doing so. Sorry, just okay. So in doing so, we would like to cover first to see and a general overview on the landscape, on international landscape in terms of the recent developments at the OECD level and the EU level. And then we would like to zoom in the country practices. And in particular, I would like to share with you the recent developments in Italy as an example of on how a country, a tax administration is meeting and fitting into this general international landscape. And then we would like to draw some conclusions in order to leave the space for a debate. In terms of the international debate, I would like to share with you this nice graph, this nice slide that we presented at the FTA, the Foreign Tax Administration, in the last general meeting in Santiago in Chile, in order to see where the dispute resolution fits within the larger, broader framework of the tax compliance. If we look at along a time scale, we have a pre-audit, audit, and a resolution, not different phases. And within these phases, we might have different approaches from the taxpayer side and from the tax administration side. So for example, in a pre-audit phase, what you have is from the tax administration side is a kind of risk assessment approach. Generally, traditionally, this has always been carried out unilaterally. Recently, we have assisted to very interesting projects. For example, the ICAP project, which is a kind of multilateral risk assessment, where several tax administrations start getting together in order to have a broader overview of the risk profile, especially of multinational enterprises, in a quite cooperative, in a quite, I would say, not controversial environment. And it is interesting because when a kind of risk is identified by certain jurisdictions, then there is a kind of consulting process in relation to which the country's tax administration, taxpayers may agree on the best way on how to avoid that risk. For example, you might end up with this ICAP in proposing an APA, or proposing a mutual agreement procedure, or even proposing even a joint audit. So sometimes this would be the outcome. I think it's quite resource intensive, very resource intensive, but we have noted in this pilot project, for example, with two important multinationals, that at the end of the day, we could put together people from the audit side with people from the MAP offices or APA's offices, and within a relatively small amount of time, I remember in two cases, it was just 1 month, we could actually agree on a kind of position that would avoid years, months, for example, to handle the case under a MAPA procedure. Then, of course, you have during the following an audit, here you have the source of tax disputes. We are living in a world, in a post-BEPS world, I would say, where all the efforts in order to tackle double non taxation have raised concern for double taxation. In the previous panel, that was apparent, and I think it was very well noted. And therefore, the efforts from the OECD, at the OECD and at the EU level have been to introduce and to speed up and to make a larger recourse to dispute resolution mechanism. Well, it is no surprise that, for example, at the OECD G20 inclusive framework level, Action 14 that can implement it via the multilateral instrument is a minimum standard. So the importance recognized by inclusive framework of members to increase the efficiency and the effectiveness of mutual agreement procedure is witnessed by the provision of the Action 14. And as we know, the Action 14 is quite large because through Action 14 we cover double taxation involving EU, non-EU versus non-EU countries, and throughout mutual agreement procedures under double tax treaties. At the same time, it is very interesting to note how this developed also, how the arbitration convention that only covered the transfer pricing cases at EU level developed into the recent Council Directive EU 2017-1852 on tax disputes. The Dispute Resolution Directive is a very important and I would say a major step forward in order to make a dispute resolution mechanism more effective, since, for example, the scope of the Dispute Resolution Directive, of course, is broader than the Arbitration Convention. One important thing is that fits with also some kind of recent developments at OECD level. If we go back to the three main pillars of the Action 14, the three main elements of minimum standard, one very important element is to ensure that treaty obligations are implemented in good faith and that MAP can be resolved in a timely manner. Apart from the option for the arbitration, of course, the OECD and the inclusive framework has started, and countries and governments and tax administration started thinking about on how to make these, how to make prescriptive something that cannot be, you cannot prescript good faith, you cannot prescript timely manners. These are quite, you know, principle-based concepts. So one interesting tool that has been used is these so-called MAPS statistics. In other words, when the Action 14 was published, was approved, jurisdictions committed to seek to resolve MAPS in a timely manner. So jurisdictions seek to meet the minimum standards by agreeing an average time frame of 24 months in order to close a MAP procedure. It is very important then the inclusive framework started implementing some kind of incentives or deterrence kind of approaches in order to monitor the compliance of jurisdictions with this minimum standard. So there is a periodical review on the basis on an agreed upon reporting framework. So governments, especially the MAP mutual agreement procedures offices within the tax administrations, are bound to agree upon this reporting framework. And for those of you that have not had a chance to do that, I would suggest to go on the OECD Inclusive Framework website, because on November 2020, on 18 November 2020, the OECD released the first MAP statistics concerning the year 2009. Very interesting, because they also published and re-elaborated all the data gathered from all the jurisdictions, and also introduced this kind of MAPS awards in order to recognize the particular efforts of specific countries. So there are some kind of rankings and categories. For example, as you can see here in the slide, that in concerning the year 2019, Japan and United Kingdom have been considered the winners in terms of the shortest period to conclude the APAs. But then there are other categories. I will come back later on this. And I think it's important to also to consider this kind of pressure on tax administration when the multinationals deal with mutual agreement procedure and even APAs. Let me zoom in some concerning country practice in some recent developments in Italy, because I think it would be interesting to see how an example of a country on how it's developing in its MAPA practice according to the general agreed framework. In 2020, we have implemented the EU Dispute Resolution Directive. So now Italy is fully compliant with the EU Dispute Resolution Directive. This means that multinationals have the possibility, of course, to resolve transfer pricing disputes by opting for an Action 14-based map on one hand, or under the EU Dispute Resolution Directive, of course, if the case is between European Union-based countries. We have also introduced some very interesting amendments to our APA's legislation. And in particular, we have also introduced the rollback for the effects of an APA when it deals with a unilateral APAs. This has been considered in the recent Italian budget law. And as a matter of fact, we have extended what was provided for bilateral and multilateral APAs now is also granted to unilateral APAs. In terms of development of case solved, we have witnessed to a serious increase over the years of the case solved. Of course, we started in this, as you can see in this slide, prior to 2017, the competence for the conclusion of a mutual agreement procedure, especially in transfer pricing on our allocation profit to PE and other, was the competence was at the level of Ministry of Finance. Then there was a recognition that MAPs, APAs are not a kind of policy issues, but are more technical. Once you have implemented the proper legislation, or once you have concluded a double tax agreement, then the handling the case is more a kind of, as it happens in the majority of countries, OECD and non-OECD countries, the tax administration is in charge for that. And since then, as you can see from 2017, we have in this slide, in 2017, we started with a total of 62 cases closed, and then sorry, let me get back to the slide. And in 2019, Italy significantly intensified its relationships with MAP partners. So we closed something like 215 cases, which is a very important step for us. Getting back to the MAP awards and to the MAP, the OECD inclusive framework statistics, here you can see something, some excerpts from those charts. And I think it's very interesting. As you can see on the upper left side of the slide, you have these 2019 MAP statistics at a glance. It's interesting to see how the start inventory at January 2019 and are reported here. For example, the average time to conclude a transfer pricing case is 30.5 months. So I think Italy is so it's above the average time that is set out by the minimum standard of Action 14. Italy is a little bit over the average time of 24 months. It's around 25, 28, if I recall well. What I think it's interesting is if we go through the various categories, for example, we have category 1, which is the average time to close MAP case. We have United Kingdom, as I said before, and Japan ex aequo. Then we have Switzerland, 23 months, and Netherlands, and Italy is fourth here. So it's a kind of very good result for our administration, considering that we had a quite large inventory of cases coming from the years before 2017. If we go through other categories, for example, in terms of cooperation, We have closed, Italy and Spain, we got the second ranking, as I said, in terms of cooperation with a treaty partner. So the methodology that was used by the OECD here was to measure the highest agreement ratio for a pair of jurisdictions in percentage. So you see, when tax administration and when multinationals, when taxpayers look at these figures, well, I think that first of all, there is an issue of transparency. We are making our processes transparent, and I think this is a very great achievement. But at the same time, I think that we are pushed, and also the governments are pushed to give more resources to, if they see that there are good results in terms of effectiveness in these important procedures. So again, if you really are interested in removing double taxation, as much as you are interested in removing double taxation, you need to invest in this kind of instruments. Let me conclude before giving the floor to Professor Danon and Professor Chan on some preliminary conclusions that we might draw from this larger view. As we said before, all the efforts in order to tackle double taxation, for example, at BEPS level, at the European Union level, with the, for example, with the ATAD directive, well, if you risk to increase disputes, especially in transfer pricing, cross-border disputes. Therefore, it is essential to have effective dispute resolution mechanism. Otherwise, you will end up with unresolved double taxation. And as we know, double taxation is an obstacle to the cross-border trade and to the development. What we see from our experience, from Italy's experience, we have seen that there is a great value if you adopt internally some kind of horizontal working. It is important that people that are in charge for transfer pricing audits, they know what will be the outcome of the audit, for example, in terms of possible outcomes as in arbitration or mutual agreement procedures. So you really need to adopt approaches that are agreed at international level. It's not unilateral. TP can be unilateral. You should think from the audit side to apply the arm's length principle in an appropriate way. At the same time, it's important if you perform risk assessment, either at ICAP level, either with pilot projects, either at, you need to deal with people working on the APAs when taxpayers need to seek for advanced certainty, or with people working with the mutual agreement procedures. You can't really work in isolation or in silos. So we are very in favor of horizontal working practices within tax administration. It's also important to mix these tools. You have, taxpayers now have a wide range of tools available in order to resolve double taxation. So an effort is also to think on how you can combine these tools together. For example, in order to ensure tax certainty, we see that when you close in an agreed way the past through a mutual agreement procedure, then that's a great investment that the taxpayers and the tax administration can use if facts and circumstances are the same, of course, in order, for example, to start an APAs, so that the APAs will be much more efficient and effective because you, of course, you rely on the work for done. And at the same time, you can provide tax certainty to taxpayers, and tax administrations can devote their resources to higher risk taxpayers. I think I have the time assigned is over. I am at the conclusion, and thank you for your attention.
Thank you very much, Valerio. It's a pleasure to have you once again at the University of Lausanne. I think we are just on time, which like a Swiss clock, I would say. So I don't know if there are questions. Perhaps one question that I have for you is, of course, you have outlined various avenues to prevent and solve disputes. And of course, we know that there is already significant pressure in terms of the capabilities of the various competent authorities, at least in some countries, to address disputes swiftly. In your opinion, what is the role in this respect, or the possible role of capacity building?
Thank you, Robert. And I think that in your as far as my personal opinion, your question embeds the right answer because in capacity building, it's one. To me, is one of the most important tools that in relation to which international organizations and countries, developed countries, emerging countries, developing countries should invest. Just to make you an example, we have delivered recently some very interesting technical assistance programs. So one, for example, was I think the most recent one was with Georgia. And they asked us to have a kind of sharing the experience on how to better and to improve and to set up their APA program. And the nice thing was that they really did not need to have yet once another presentation on arm's length principle or Article 9. And so they're very good. They're very good. Their auditors are very good, are very experienced in that. What they really missed was the practical, the pragmatic part of the issue. One, of course, you can understand that you can have a great and wide knowledge of Article 9 from a theoretical level, which is essential, which is necessary. But then when you interact with the taxpayer, you need to understand what are the right questions, so how to set up the process, how to trust the taxpayers in relation to some information that are provided and what is not. So this is something that you can't read in the books. And I think that cooperation between countries, Tax Inspector Without Borders, for example, is a great initiative. We did something recently also with other countries, including Georgia. And so the answer is yes, yes, yes. Technical assistance is a key in order to help other countries to move on and to develop their practice in order to address the double taxation, even double no taxation, of course, because in this kind of technical assistance, there are also programs, for example, in terms of risk analysis on how to measure on how to make out the best out of your resources in order to tackle aggressive tax planning. So it's, you know, there are two faces of the same medal.
Thank you very much, Valerio. Vikram, I think I give you the floor to close the session and transit through to the next item.
Yes, actually, in terms of closing comments, I will just take a question from the audience. It's from Jeff van der Walk. His question is to you, Valerio. Hi, Valerio. Two questions first. Have you brought on any vintage guitars recently? And the second question is, having worked with the CTPA on the BEPS project and now working in the Italian government's tax administration, do you feel that the Pillar 1 and 2 proposals are needed? Or do you agree with those who feel that the proposals are premature since the effects of the BEPS project are not really known? All the best.
Well, thank you, Jeff. And I much more prefer the question on vintage guitars, actually, even though the answer is no. Well, very great question, and quite well. I think that we do not have much choice. I think that as it was said in the previous panel, we really need to address these complex issues through a kind of multilateral approach. Italy has introduced, for example, the digital service tax, as other kind, I think, other 9 or 10 countries around the world. And of course, we need to make it work as a tax administration. We see that there are a lot of difficulties and we are trying to provide, we put in public consultation recently a Director General's decree in order to provide some kind of clarifications or rules to taxpayers in order to meet these very complex rules. And I think that in the medium term, in the long term, handling multilaterally unilateral digital service tax can pose very, very high concerns. So I think that a multilateral approach is something that we really need to take into account. I think that the presentation before by Matt, Andrew, was terrific in highlighting also the complexities of these approaches. But I think that we shouldn't stop keeping on trying to develop solutions, multilateral solutions, simply because they're difficult. So I think that is a kind of mandatory way forward. Great to hear from you, Jeff.
Thank you very much.